Good evening, all the joinees. Thank you for joining in. Hi, this is Ashi. I welcome you all for today's webinar. Meanwhile, others join in. Let us have a look at today's topic. So today we'll be looking at what are the various risk parameters that are used for analyzing mutual funds. So we'll be looking at value at risk, up capture and down capture ratio, then followed by rolling analysis, and lastly, we'll be looking at drawdown and recovery analysis. And at last, the forum will be open for a Q&A session. Now, this is the landing page of NGEN Markets. We'll now be moving towards the fund section. Now, as soon as you come towards the fund section, this is the place wherein the screening and selection of mutual funds take place. Now, here you can filter the funds based upon the AMC, or you can filter it based upon the categories as well. As you can see that there are 4 baskets which basically represents SEBI asset classes and within which are the multiple categories that are listed. Now there is no limitation. You can select as many categories as you wish. So for today's webinar, we'll take up the example of large cap funds. Now to load all of these 33 large cap funds onto the screener, you simply have to click on this checkbox. As soon as you do so, all of the 33 results will get loaded right here. Now you can also apply certain basic filter parameters to narrow this list down. This can be basis AUM, it can be basis minimum age, or it can be basis historical VAR. Now let's say I only want those large cap funds that has AUM of at least 5,000 CR. So in minimum AUM, I will input 5,000 right here. And let's say I only want those large cap funds which have completed at least 5 years of age in the market. So in minimum age, I will input 5 as an year. Now, once this is done, I will simply click on apply so that the system can take it into effect. Now you can see from 33, we have come down to 12 such large cap funds that have AUM, which is minimum 5,000 CR and has completed at least 5 years of age in the market. Now, as soon as the list gets loaded right here, you can see that there are multiple parameter-wise information or fund-related information that you can find right onto the screen. Now, to get only risk-related column out of the several other columns that are mentioned, I'll click on the drop-down that states preset column view. As soon as I click on this drop-down, I will then select risk column. So all of the columns that are related to risk, you would be able to see in the funds column. Now, since this is the funds column, data like Sharpe ratio, value at risk, Sortino, standard deviation would be since the inception of all of these funds. So it is very important that you load these funds in the compare tab. But before that, let us try to understand these parameters on the basis of single fund analysis. Now, for example, if you want to know what is VARH or VARI, let us try to understand this by loading a single fund analysis. Now, for example, if I click on iProve Blue Chip Fund, it will load a single fund analysis. Now, as soon as a single fund analysis gets loaded, you would be able to see certain information onto the left-hand side. Like, for example, ISIN, AMFI code, asset class, category. Similarly, you can also see there is an option to change the start date and end date. So you have complete flexibility to do so. Now, since the funds basis the risk detail that we were looking upon in the funds tab was since the inception, I will also change the start date for this particular fund to the inception. So I will click on the word change and then I will simply select inception right here. Now, as this gets loaded, the first tab would be performance tab, wherein you would be able to find several parameters basis which you can compare a fund's performance versus to that of the relevant benchmark. Now, there are 2 types of VAR on the platform. First is historical VAR and second is implied VAR. Now, VAR is an abbreviation of value at risk. The difference between these two VAR is what we take in denominator when we calculate the same. So when we calculate historical value at risk, we take historical returns under consideration. And when we calculate implied value at risk, we take historical volatility under consideration. Now, as you can see, there is 95% mentioned in a blue color box. Now, what does this mean? This basically indicates the confidence interval. Now, you can put as per the industry standard 90, 95, or 99. Now, let's say I change this to 99%. As soon as I do so, I'll get hit on outside the box basically. And now we'll read this particular data. Let us try to understand as to how you can read this data. Now for historical VAR, we can say that with 99% confidence interval, that there is 1% probability, meaning 100 minus 99. So there is 1% probability that a fund can generate the negative return of 48%, whereas the benchmark to an extent of negative 54%, if the history repeats itself. Now, similar would be the reading for implied VAR. Now, here you can see that the confidence interval is 95%. So, what does this mean? The reading would again remain the same. Here we can see that with 95% confident interval, we can say that there is 5% probability that this particular fund, which is iPro Blue Chip Fund, can generate a negative return of 29%, whereas benchmark, that is Nifty 100, to an extent of negative 32%. Again, if the history were to repeat itself. Now, in simple words, if 100 rupees in invested in both this fund as well as the benchmark, the capital erosion for the fund would be rupees 29, and for the benchmark, it would be rupees 32. So just to summarize VAR is an abbreviation to value at risk. It should be as low as possible. Historical VAR takes under consideration historical return, and implied VAR takes under consideration historical volatility in denominator. Additionally, you can also check standard deviation of a fund under annual volatility. Now, this is again since the inception of the fund, because the start date that we have selected is basically since the inception of the fund. So for fund, we can clearly see the annual volatility is to an extent of 18%, and whereas the benchmark, it is to an extent of 19%. So we can clearly see the standard deviation of our fund is lower in comparison to that of the benchmark, which is Nifty 100. So again, the standard deviation should be as low as possible. Now let us try to understand all of these parameter basis peer comparison and versus the benchmark. So for that, we'll now head towards the compare tab. So I'll move back to NGEN Markets. And this is basically the landing page of the compare tab. Now to load the funds in the compare tab, there are two ways. So in the fund section, as we have already filtered some funds out basis AUM as a filter parameter as well as age as a filter parameter. In the fund section, you can take your desired funds by clicking on this add to compare as an icon. So once you click on this, all of your desired funds that you want to analyze will get loaded right here. Or what you can do is you can simply click on add top 50 to compare. So in just one click, all of our filtered funds have now been listed in the compare tab. Now, please note the data in the compare tab is again since the inception. So we'll take a start date. So let's say you want to analyze all of these funds for the period of past 5 years. What you will do is you will click on this settings wheel icon, which is right beside the word return columns. Once you click on this settings wheel, you can custom your own start date. Now, since we are analyzing the funds risk parameter basis past 5 years, we'll select accordingly. So I'll click on this drop down 2020 1st April, and then I'll hit on go. Now, as soon as you hit on go, there will be a prompt stating that a custom start date is being selected. Now we'll also add a benchmark and see which all funds are less risky or more risky considering various risk parameters. So for adding a benchmark, I'll use this add other item as a section and I'll search for the relevant benchmark. Since we are analyzing the large cap funds, the relevant benchmark would be Nifty 100. So I'll search for it right here and I'll just click on it. Now as this gets loaded, we'll now start with the analysis part. The first parameter that we'll be looking at would be this VAR, which is again the abbreviation of value at risk. Now you can sort this in ascending or descending order by clicking on the word VAR. So as I sort this from highest to lowest order, we can clearly see that Franklin India has a VAR, that is value at risk, of about negative 25%, which is the highest not only in comparison to its peers, but also in comparison to that of the benchmark. Now, since there is no confidence interval that is mentioned, so by default, what we would consider would be 95%. So again, the reading would remain the same. With 95% confident or confidence interval, we can say that there is 5% probability that Franklin can go down by 25.27% if the history repeats itself. And similarly, if I sort this basis lowest to highest, we can see that the lowest value at risk is by DSP Top 100 Equity Fund, which is to an extent of negative 21%. Now, the next parameter that we would be looking upon would be this standard deviation. Now, if I again sort this basis highest to lowest in terms of standard deviation by clicking on the word, we can see that Nippon India has a highest standard deviation of about 16.06%, which is also more than that of the benchmark, which is to an extent of 15.76%. Now, standard deviation is a measure of volatility, so lower the standard deviation, the better it is. Now again, if I sort this in terms of lowest to highest, you can check the same that which all fund has lower standard deviation in comparison to that of the benchmark. Now the next parameter that we would be focusing on would be this Sharpe ratio. Now Sharpe ratio is risk adjusted return, indicating how well a fund is doing in terms of generating return in comparison to the risk that it has been taking. Now, again, if I just sort this basis highest to lowest, we can clearly see that iPro has the highest Sharpe ratio, which is to an extent of 1.26%. And similarly, if I sort this lowest to highest by clicking on the word Sharpe, we can clearly see that here Axis Blue Chip has a Sharpe ratio of 0.76. So higher the Sharpe ratio, the better it is. And similarly, you can also check for Sortino ratio as well, which is again risk adjusted return considering the downside risk. This can also be sorted in ascending or descending order accordingly. Now, the next thing that we would be looking at would be some pink color coded column. So for that, I'll simply scroll onto the left hand side. Now, these are the relative return column. Currently, there is no data. So to activate the same, we'll click on the checkbox right here, which states relative returns. Now, as soon as you come to the relative return column and click on this particular checkbox, there are two pieces of information that you have to keep in mind. First is the benchmark. Now here, as you can see, by default, the benchmark that is being selected is Nifty 50. But the relevant benchmark here would be Nifty 100. So I will change this to Nifty 100. So whatever benchmark you have taken for return column, that should be similar to what you would be taking up in the relative return column as well. Now, similarly, second piece of information that you have to keep in mind would be this start date. So whatever start date you have taken for the return column, similar start date is something that you would be taking for relative return, that is pink color column as well, so that the fair analysis could happen. So I will pick up the same start date, which is 1st April 2020 right here. Now, as soon as I've changed the benchmark to the relevant one, as well as have picked up the similar start date as to what we were analyzing for the returns column, so that the fair analysis could happen, now the data is ready for the purpose of analysis. Now, the first thing that we would be looking upon would be this beta. Now, beta is simply an indication or indicator of risk. Now, as we are aware that index has a beta of 1, we can clearly see that Nippon here has a beta of 0.98, which indicates that the fund is risky not only in comparison to its peers, but it is not as risky as the benchmark. So again, lower the beta, the better it is. To be more specific, if beta is less than 1, it would be considered better. Other than beta, the two important ratios mentioned in the relative return column is this up capture and down capture ratio. Now, to understand this, we'll load a single fund analysis. For that, I'll click on this Nippon India Large Cap Fund. Now, since we were analyzing the up capture and down capture here for the period of past 5 years, basis this particular start date, I will also take up the same start date for analyzing the up capture and down capture of this single fund. So 2020 and 1st April. As soon as I've changed the start date, now we'll scroll down and here you can clearly see there is up capture and down capture ratio mentioned. Now, up capture ratio talks about how well the fund was doing when the market was in bull run. Here we can clearly see that the up capture ratio of this particular fund is to an extent of 109.82. Now, considering that our benchmark, which is Nifty 100, had an up capture of 100, what does this mean? So, the readings would be if the benchmark was up by 10%, our particular fund, that is Nippon India, was up by 10.9%. To get a month-on-month bifurcation, you can simply click on this I button and you would be able to see a monthly breakup for the same. Now here, only those months would be taken under consideration wherein the benchmark was generating positive return, irrespective of our fund generating either positive or negative return. And on top, you can see the overall return that is being generated by the fund as well as the benchmark. Now, once you divide this, it will come up to 109.82. That is something that is indicated right here. So if up capture ratio is more than 100, it is considered good. Exactly opposite would be the down capture ratio. So down capture ratio talks about how the fund was doing when the market was in bull run. Now here we can see that the down capture ratio of our fund is about 86.40. Now again considering that the down capture ratio of our benchmark was 100, what does this mean? That when the benchmark was down by 10%, our particular fund was down by only 8.6%. Now once again to get a month-on-month bifurcation, you can simply click on this I button right here. And please note here only those months would be taken under consideration wherein the benchmark was generating negative return, irrespective of our fund generating either negative or positive return. And on top, you can see what was the overall negative return generated by the fund as well as the benchmark. Again, when you divide these two returns, it will come up to 86.40. That is something that is reflected right here. So just to summarize, if down capture ratio is less than 100, it is considered to be good. Now, the next thing that we would be talking about would be the rollings. So for that, I'll head back to the platform again. And in the compare section itself, you can find a separate tab for rolling. So I'll move towards the rollings. Now, rolling talks about the consistency of the funds. Now, the first thing that you would be able to see here would be the rolling window. Now, we calculate rollings on a daily basis. And here what you see 260 is basically 1 year working period. So in 1 year, there are total 260 working days. But let's say you want to check for 2 years rolling window. So for that, you can simply multiply 260 into 2, which is 520, and input the number of working days right here. Also, you have complete flexibility to input a start date and an end date. Once you do so, you would then be required to click on run so that the system can take it into effect. Now, the first column here consists of all of the name of the funds that were on our main list, including the benchmark as well, which is at the very bottom. The second column is the average, which is basically the average rolling return. You can also sort this in ascending or descending order and check it accordingly. So for Nippon India, we can see that the average rolling return for this particular fund is to an extent of 15.65%. The third column here is vol. So vol basically stands for volatility. Anywhere on the platform, if you see the word vol, that basically indicates volatility. Now this is the rolling volatility. You can also sort this as well. So for Nippon India, we can clearly see that the rolling volatility is to an extent of 9.72%. The fourth and the fifth column talks about the lowest and the highest return that a fund has generated between a particular start date and end date. So for Nippon, we can see that the highest return generated is to an extent of 43%, whereas the lowest return that it has generated, considering this particular start date and end date, is to an extent of negative 14.7%. Now, the next thing that we would be looking upon would be this range. Now, range basically talks about the swing between high and the low. So, higher the range, highly uncertain or highly volatile that particular fund is. So, for Nippon, the range is about 58%, which means that this fund can go as high as 43%, but it can go as low as negative 14% as well. The last column talks about positive percentage. Now, this indicates number of times a fund has generated return in positive or mainly above 0%. So, for example, Nippon, we can clearly see 94% of the time this particular fund has generated return in positive or above 0%. So this is how you can analyze the rolling data for the list of funds. You can also do the same rolling analysis on a single fund basis. You just simply have to click on that particular fund's name and a single fund analysis again would get loaded right here. And there is a separate tab for rollings. Now, as soon as you come towards the rolling tab, here you would be able to analyze for three rolling windows simultaneously. 260 being 1 year rolling window, 520 being 2 years rolling window, and 780 being 3 years rolling window. This is anytime editable. Let's say you want to check for 4 years, you can simply multiply 260 into 4 and input the number of days in any of these boxes, and then you can just hit on run and the data would get generated right. The view is available on an absolute basis as well as on an annualized basis. Now, the next thing that we would be looking upon under the risk parameter would be drawdowns. So for that, I'll again go back to the compare tab. And here you can find a separate tab for drawdown as well. Now, as soon as you come towards the drawdown, drawdown basically talks about the strength of the fund to recover from its losses. Now, here you can find the details of top 5 worst drawdown. Now, there are three columns within each of these worst drawdown that are being mentioned right here. First is this size. Now, size talks about the loss. Next is the length. Now, length talks about the number of days it was in that particular loss. And recovery talks about number of days it took to recover from that loss. You can anytime sort this in terms of recovery and check which all funds were able to recover faster, not only in comparison to its peers, but also in comparison to that of the benchmark. Now, to get a detailed view basis what was the fall in the NAV and exactly when did it recover from its loss, you can click on this chart icon right here. Now, for example, for Canara Robeco, we can see that there was a loss of 32%, which was between 19th Feb 2020 till 23rd March 2020, wherein the NAV of this particular fund, it fell from 28 to 19 and it took 144 days to recover. And when did it finally recover? It finally recovered on 9th of October 2020. Also, there are certain ongoing corrections or recovery that are also highlighted on the platform. Now, all of these data is also available on a single fund basis. The similar procedure, you simply have to click on a particular fund's name. It will load a single fund analysis. And again, within the single fund analysis, you can find a tab separately dedicated for drawdowns. Now here you can find the details of top 10 worst drawdown with a graphical representation wherein the gray section talks about the loss phase and the white section talks about the recovery phase. All of the data that you see here can be downloaded in the Excel format as well. Now the next thing that we would be looking upon would be the risk versus return scatter plot. In the Compares tab itself, you would be able to find a separate tab called Risk versus Return. Now, as soon as you come here, you would be able to see that there are certain quadrants. So on the left-hand side, on top, it is low risk, high return. Bottom is low risk, low return. On the right-hand side, top is the quadrant for high risk, high return, and bottom is high risk, low return. X-axis considers risk and Y-axis considers return. You have complete flexibility to custom your own start date and end date as well. Now you can also compare two funds side by side. Now, for example, if I compare iPro with Mirai Asset, we can clearly see that the return that these two funds are generating is somewhere about 14%. Whereas the risk that iPro is taking to generate this 14% of risk is to an extent of 15.4%. Whereas Mirai Asset is taking a risk of about 15.7% to generate a similar amount of return. So what you can do is you can take iPro as an alternate to Mirai acid because without compromising on the return, while it is generating similar amount of return in comparison to Mirai acid, but taking considerably a lower level of risk. So basis the risk appetite of the client, you can definitely suggest them the fund while reading this particular risk versus returns catalog. Similarly, you can also see the benchmark's risk and return versus to that of the fund. So we can clearly see that benchmark has a risk of about 16% while it is generating a return which is somewhere about 11 to 12%. Whereas for Nippon India, we can see that though it is taking similar amount of risk, which is 16%, it is generating a return which is much higher in comparison to the benchmark, which is to an extent of 14%. All of the data that you see here, you can also download it in the Excel format. So all of the information that we were seeing here on a single fund basis, as well as for the list of funds, is also available on the portfolio level as well. So once you come towards the portfolio section, you then have to simply click on the drop down and run the analysis. Once the analysis gets started, you can definitely pick up a start date and end date and check accordingly. So you would be able to see there is a separate tab called risk versus return. This is on portfolio level. Not only does it divides as to where a particular component is falling in a specific quadrant, it will also tell you the risk and return of the portfolio versus to that of the benchmark. Similarly, you can also find rollings as a separate tab in the portfolio analysis, wherein again you can check the rolling window for 3 simultaneous rolling window for that matter. And again, the view is available for absolute and annualized, and accordingly, you can also edit this rolling window right here. And lastly, we also have drawdown analysis for overall portfolio, wherein again you would be able to see what are the top 10 drawdown. And also there are certain ongoing recovery, which is also highlighted onto the portfolio level as well. So that was all for today's topic related webinar. Now forum is open for a Q&A session.
Hello. Hello. Am I audible?
Yeah, please go ahead.
Yeah, a couple of things. You left trainer ratio and information ratio when you were covering those risk parameters. That is one. Second, can we choose the parameters at the time of this portfolio analysis to be included in the PowerPoint output? Say there are 10 different parameters. I want to only 5 of them to be covered in the PowerPoint portfolio, this PowerPoint presentation. So is it possible?
So currently we don't have any possibility of customization. At this point, basically whatever you see in the table is actually printed out. We can look into it, but there are just a few parameters here, as you can see in the pink column. So those are all printed in the PowerPoint.
Yeah. Because reason is very simple. Not all the investors are so savvy that they can make out anything out of that. So keeping in mind the level of awareness of individual investor or family, we can customize the PowerPoint presentation. So that is one suggestion which I wanted to make.
Sure.
That what
Here,
all I want
yeah.
to include in the PowerPoint presentation.
Yeah.
And
So here, there's also one thing is that if you create a portfolio PowerPoint, I don't believe we get a similar table there. So that might not be as in-depth as the compare section. We can just show you that.
Yeah, yesterday I did download, and then I had to uh, download the Excel files and then copy and paste and to make those changes, and then
Um,
delete the slides. So many uh, things
so here,
I was required to do. So
yeah,
if that option is included, that will add value only to the software, to the platform.
yeah. So what we're showing you, I think already has what you need. If you create a portfolio instead of the compare list, if you get a portfolio, um,
Yeah,
all those ratios won't come here, just the basic ones come here. You can see this portfolio PowerPoint. This is different
yeah.
from the compare section. So this is all readily available.
Okay, okay. So that customization, as I said, it is a suggestion. So that I want to, I can increase or decrease as per.
Yeah. What we can try and do is give our users an ability to include or exclude one of the pages that are already there. So you can at least
Yeah,
select which pages.
yeah, correct.
We can work on that. Yeah.
Yeah.
Hello. Hello.
Yeah.
And secondly, when she was covering the ratios, I think she covered Sharpe and
Yeah, we
one
have
more.
information ratio. We don't currently show trainer
Yes.
ratio. I don't think we do.
Just before that, oh, okay, it is tracking error. Okay.
Yeah.
Okay.
Tracking error and information ratio.
Yeah, yeah. Uh, okay. So can she explain that information ratio for the benefit of all the participants?
So information ratio is not very different from the sharp ratio calculation, but the calculation is similar, but the things it uses are different. So for example, here what you see is it looks at the fund versus the benchmark, and it looks on a daily basis how the returns are, as in terms of fund minus benchmark. So it's excess return divided by the tracking error.
Okay.
So this is only useful if you're doing a relative analysis versus the benchmark. So both
Mhm.
tracking error and information ratio are usually only useful for funds that are particularly tracking a benchmark. For kind of
Okay.
an alpha-oriented fund,
More,
I would say no use to look at
it
tracking
is
error for an alpha fund.
okay. So it is more for index funds, passive funds.
Exactly.
Got it. Thanks.
No problem.
Yeah, hi, Anurag.
Hello.
Yeah, hi, can you hear me?
I can. Please go ahead.
Great. So I was just going through some client portfolio today. So can you do me a favor? Can you search for say SBI multi-cap over here and add it?
Yeah, let's go into it.
Yeah. Uh, yeah. Yeah, can you open it? Yeah. Can you open it? Now, if you go to the asset allocation and say suppose you select this Krishna Institute, the fourth one from the bottom, the stock. Yeah. So can you help me read this chart? How do we read this properly?
Yeah. Obviously, this is it looks like obviously a
Sir, you're actually on mute.
Oh, sorry about that. No,
Yeah,
I'm
I was
saying,
waiting for
yeah.
you.
Oh, sorry, I was speaking. Apologies, I was on mute. No, I'm saying this is actually this is because obviously there's been a split and the price has not been updated, our data provider unfortunately doesn't adjust for these when they send it to us. So we currently have a manual process of kind of looking back at issues and then
Okay.
fixing them. This one looks like it's been missed, so we will fix this immediately.
Right, right.
And also,
Say if you were to configure something out of this graph,
yeah,
so on the left is the stock price, and on
yeah,
the right side it's the index, how it has moved.
that's right.
Right?
So basically, you have to imagine that the blue line,
Hmm.
the later part of the blue line after the very sharp drop, once the price is adjusted, it will come all the way up to where it started dropping from, because that
Correct,
drop is obviously not real, right?
correct,
That is just the
correct, correct,
price
correct.
becoming
Yeah, it
25
is a
instead
corporate
of
action. Yeah,
15.
yeah.
Yeah,
Correct.
yeah, yeah, yeah. So
Hmm.
that adjustment isn't currently done automatically. We are working on, kind of getting a new data provider to help us with
No
this.
problem, no problem.
Yeah,
Also, just one more thing.
yeah,
Can we put some other benchmarks? Say suppose for this, like, for example, this is a small cap fund. If I were to
sure.
see it compared to a small cap index, can I
Yeah,
change it instead of this? And
of
if you
course. Yeah, let's just change to any small cap index. You can just change the benchmark in this analysis right here. So the benchmark then changes. You can even
great.
create your own custom benchmark. So it's the same thing that's available to, to you for funds,
Other,
portfolios. It's the
correct.
same thing.
Got it. Thanks.
No problem.
Okay, on the the thing that she was explaining on up capture ratio and down capture ratio earlier.
Yeah, yeah.
You showed with that information button that monthly return data of the fund versus the benchmark. And then she said this combined value of up capture and down capture is, so what, how exactly it is found out? I mean, is it the average of all the months or here, yeah. She said this is one divided by the other, right? So it is the fund return divided by the benchmark. Up capture ratio is fund return divided by benchmark, I guess, here.
Sir, you're actually on mute again.
Am I on mute? No, I
Oh,
am not.
sorry. No, I am, sorry. Again, my problem. Yeah, so here what you're looking at is up capture ratio. So
Yeah.
the way we are doing it is basically, first we isolate all the months where the benchmark is up before we even look at the return of the fund or the asset, whatever it is.
Mhm.
First, we isolate all the months where the benchmark is up. And these
Right.
are obviously calendar months. That's just in
Okay.
the definition.
Okay.
Now, after that, only on the ones where the benchmark is up, we see what the asset did. So, so basically, now you can take April 2020, for example. Benchmark was up 18.1%. The
Mhm.
fund was up 16.22. So
Mhm.
a little less, right?
Yeah.
You can see in a few of these months, maybe it did better. Like in November 2022, it did better than the benchmark. But only on the months when the benchmark was up. We don't consider the months, in this case, where the benchmark was down. So
Mhm.
basically, it's showing you the capture ratio effectively is trying to say how much of the upside is the fund able to capture. Upside as an upside of the market. In this case, the market is represented by the benchmark. So
Mhm.
same thing applies to the down capture. How much of the downside is it
No, no,
capturing?
no, before going there, so this
Yeah,
you did for those months where the benchmark is positive, I understand.
correct.
And
Yeah.
then to find the up capture ratio, you divide the fund return of that particular month divided by the benchmark return.
Well, I don't think it's divided. I think basically they take the average of each of these months and they compare it to the average of the other months. I mean, I'll have to look up the exact calculation. We can send it to you also. But by the way, I mean, this is very standard. Even, if you look on Investopedia,
Mhm.
we actually follow exactly those definitions. So if you look at up capture ratio in Investopedia, we actually follow the formula exactly.
Okay.
So again, what it will show you is how much of the upside of the benchmark was it able to capture. Over 100 means more. Below 100 means less.
Yeah,
It wasn't able to capture as much.
right. Yeah, that I got it.
Yeah.
I was just wondering how that average is figured out. Is it that for every month that is calculated that ratio and taken an average, or
I apologize. I can't remember right now. I mean, I'll just have to look it up on Wikipedia. Sorry, Investor
yeah,
Variance here.
somebody can send me
But
that
it's
link.
yeah, we can send it to you. We can send it to you separately. But it's a very simple calculation. And
Okay.
obviously, down is exactly the same thing, but in opposite.
All
And
right.
there you don't want to be 100 because you don't want to capture all the downside. It's
Absolutely.
better that you capture less of the downside.
Right.
So these numbers are actually quite nice.
Okay.
109 and 86.
Right. Yeah. Absolutely. Okay, fine. Yeah, thank you.
No problem.
Arunab, hi, this is Girish here. Quick
Hello.
question. Arunab, hi.
Yeah, go ahead, please.
Yeah. Quick two questions. One is a hygiene question. So for, I think the lady did a fine job in terms of explanation, but at certain points, I just felt it was a little rushed, as in the sense that there was hardly any space and we just kept moving. So will a recording be available for future consumption? I could see that the session was recorded in case I want to go through it again.
Absolutely. All our webinars, are available online. So basically, can we just quickly show the the YouTube page? So this page that you're looking at, there is a link to this page right at the top of the application.
Okay.
I mean, otherwise you can just search YouTube NGEN Markets and you'll get the first result. And here we have a playlist called webinars. And I think it has
So every
almost
webinar
2
gets
years.
uploaded here. So which
Every
means
single one.
Okay.
Every single one. So even the one today, in about 2 to 3 days, somebody processes it, and then it's up to date. Definitely kind of by like mid next week.
I think that's fabulous. Thanks so much.
No
Second
problem.
quick question is not so much to do with, I'm sorry, maybe it's a slight digression, but I just wanted to check. By when will NGEN be able to provide active share at a stock level and active share at, if possible, a sector level, say for a mutual fund? Because I understand that at this point in time, NGEN does not capture holdings, underlying holding percentages of benchmarks, and that's the reason why they're not able to capture. But I was told
Yes.
it's under progress and it will happen.
It is definitely under progress. We've unfortunately not been able to find direct data providers that get it. So we are having to kind of build systems to get this data ourselves, which is what's taking time. But once we have that, just to be clear, like what you want to see is this fund in this particular stock, what is its weight versus the index weight? Am I getting that right?
One at a stock level and two, therefore, accumulated stock active share at a fund level. Similarly, once you know what stock weightage it is, you know which sector it belongs to.
Sector also.
That sector, what is the weight in the fund versus what is the weight in the benchmark. So you can get sector active share also.
That's right. So here the only issue we might be that we have over 200 indices in our database. I think it's 240 now. We may not be able to get the constituents for all of them. So
I think the main ones, which
at
is
least the major ones.
the 5-6 major ones, even if we get, it covers at least the bulk of the equity
definitely.
funds,
Definitely.
I
Okay.
mean,
That should be
100 mid cap, small cap actually covers everything.
covers everything. No, fair enough. That is being worked on, so we should have it soon. Very soon.
Thanks so much. I mean, please do take this as feedback because I think this is a critical
Will
measure, which it's an easy measure and an important measure for people, somebody who's looking for active mutual funds, investing in an active fund.
Absolutely.
Thank you so much. Arunab, in case I have any query later, is it possible to get in touch with you?
Please just drop us an email at support and we'll schedule a meeting.
All right. Thank you so
So
much.
just one quick email at support@ngenresearch.com and we can set up a meeting and get on a call.
Thank you so much.
No problem. Any other questions, please let us know.
I'm sorry, Aruna, last thing, since
Please.
about the historical VAR and the implied VAR, and
Yeah.
this is not a complaint, but
Mhm.
I have listened to the definition being rolled out by NGEN, explained by NGEN in 3 different training sessions now.
Right.
And the definitions that we are getting are absolutely identical word to word. And, honestly, I can, one more time, I hear it and I'll be able to
Right.
keep it word to word.
Sure.
It really still doesn't uh, try to help me understand what exactly is it in layman's language that
Of
we need
course.
to say in this. You know
Of
what I'm
course. Yeah.
saying?
Yeah. So basically, let's start with historical VAR for a second. This is actually, if you break it down, it's your typical percentile calculation. The same
Understand.
thing that happens with exam
Understood.
marks,
Understood.
right?
Yeah.
So if you were to do it in Excel, for example, you would basically look at, you put all the historical prices in one column.
Yeah.
You will sort them
Yeah.
from smallest to largest, and
Yeah.
then you can just simply use the percentile function in
Correct.
Excel and find 0.05. Use
Understood.
0.05, which is
Understood.
100 minus 95.
Correct.
And then you get a number. That
Yeah.
number you have to multiply by square root of 260 to annualize it.
Understand.
And so this effectively, mathematically speaking, based on historical returns, is telling you that there is a 5% chance based on probability that you
Yeah.
could be down 25% annually.
I got that.
So
And
yeah,
the second one is so the first
okay.
one is I could be 25% down, but what is the second one?
Yeah,
Implied.
the implied VAR. Okay.
Yeah.
So the implied VAR, mathematically speaking, it is also giving you a similar forecast, but the way it's calculated is very different. It's calculated from the normal distribution. So basically, what it does is it plots, it basically looks at volatility first. So you see that annual volatility 6.06,
Yeah.
16.06.
Yeah.
It basically multiplies this within Excel. You can do this. There's a
Yeah.
function called norm SINV, which is the inverse of the normal distribution. So it
Correct.
basically, if you do norm SINV in bracket, and if I'm remembering correctly, 1 minus 0.05. If you multiply this by that, you will get minus 26.42. If you want, we can send you a simple Excel showing you this.
No,
Yeah.
I've understood they basically it's just a volatility based route to get to a probability number of what the
Yes.
downside is. So I'm
Yes.
just so the way to so let me now ask you
Yeah.
when one looks at all the other measures, whether they are
Mm-hmm.
risk measures or return measures, one
Mm-hmm.
understands what they are basis the definition. All I'm trying
Yes.
to say is that here what all we're trying to highlight when you say value at risk is that if I wanted to evaluate what is the worst the fund can do
Yeah.
at a 95% confidence level,
Mm-hmm.
this is the number. That's the way to look at it.
Absolutely, it is. In
And
fact,
over what period then does
yeah.
it take?
So right, so the input data to this calculation is
Oh, it's at the
whatever
top.
your start
All
data
right. All right.
exactly,
All right.
and this is saying going forward annually this is your loss. So, for example, this VAR number that you see here,
Yeah.
this is what they use on trading desks to watch your PNL. When I used to trade, my VAR was set at by exactly this calculation. So it's a very heavily used number in finance. So
Oh.
because this is basically saying if you repeat the future 100 times, 5 out of those times you'll be
Yeah.
down this much.
Ah.
Um,
Okay.
so usually the trading losses are limited, saying if my VAR goes below 25 minus 25%, they'll stop me
Understood.
out.
Ah.
So this is quite a useful number, to be honest. I mean, even for fund selection in some of the pro strategies that we have in NGEN Pro,
Yeah.
actually use this as a filter rather than anything else for
Okay.
risk purposes. So
Ah.
especially as a relative measure within a category, let's say between small cap funds, you will
Mm.
typically find,
Mm.
I'm guessing this without looking, that the ones that show you a slightly lower VAR
Mm.
will have a much better Sharpe ratio, much more
Understood. Understood.
stable performance.
Understood. So the way to, if I were to again, use, I understood what you said, but if I were to
Yeah.
again use layman's language here, since
Mhm.
this is, we are looking at 5-year data, therefore, assuming that the future is broadly similar to the past. In
Yes.
the next, if we look at a 5-year, over a 5-year horizon, it's likely that there is a 5% chance, or as you said, 5 out of 100 times, this
Yes.
fund will be down 25% versus the benchmark being down 24%. That's the way to
Exactly.
read this.
That is it. And in fact, one thing I'll add is if your input data is 5 years, we are in 2025, so maybe it will cover the COVID period, maybe not.
Correct.
You might want to input 15 years of data because,
Understood.
or 20 years, because it'll go through the financial crisis also. In that case,
Understood.
your VAL will go worse.
Substantially
Because
higher.
now, exactly, because now it's showing it that worse things are actually possible. If the last 5 years market has been very stable, you'll get some ridiculously, safe VARs, which may not be reflective of what can actually happen if things go wrong. So
then-
the more data is, the better it is.
Sorry to labor the point then. Therefore,
Yeah.
this should ideally be seen in conjunction with, say, when we look at downside or drawdowns in isolation, what we're effectively
Yes.
looking at is just a single instance in time, whereas VAR tells us how likely the drawdown is likely to happen.
Yes,
Is that a way to
that's
see it?
right. Yes, that's right. This is actually showing you likelihood. In fact, this is a probability measure. So it's most
Okay.
definitely showing you likelihood.
Understood. All right. Thanks a ton for the
No
explanation.
problem.
I think that makes it far more clear.
No problem.
See, just when you
yeah,
were explaining the screens,
Yeah.
while explaining it to Girish, there was a screen that showed some financial planning, this, that, and all. Yeah, this.
Yeah.
What is this? I mean, I'm not able to find in my case.
So this is an upgrade that we released a few months ago. It's called NGEN Pro. If you want, we can give you separately a demo of all the features. But basically, it has inbuilt auto-generated strategies. It has kind of financial forecasting, as well as a risk profiling tool that you can use with your clients, where you can send them a link in WhatsApp, they answer a few questions, and then you get a kind of a PDF report of the results of those questions. So you can kind of keep a record that I spoke to this client. The client seems like they're okay to take risks. So if you do put them in small cap funds, then at least legally you're covered. So yeah, I mean, we have other things that we're developing for the pro side as well, but our regular updates for premium users is always ongoing. So this is an upgrade that we had. You should be able to see it on the left-hand side.
no, if you have not
in the application.
subscribed, you will not see it. So
No,
you
no,
need to subscribe to this.
No, it's
Yeah,
there. Engine Pro is I can see that Engine Pro.
You can see, yeah.
Yeah.
I think some of the strategies may not open up for you because if you're not subscribed. But if you have subscribed, then you can actually run analytics on these the actual individual funds. You can take them out, maybe edit them. So so we've got like at least 15, 20 kind of, you could call them model portfolios that are kind of ready for you. But we suggest that you take them and you can change them, edit them to your client's requirements. But at least it's a good starting point. These strategies are not, there's no qualitative input from anyone in NGEN. There is a very strict algorithm that generates these on the first of every month.
Okay. All right. I got it. Yeah. Okay. I've never seen that one. So, okay.
Yeah. Sure. No problem. Any other questions? Please let us know.
Yeah. You see, when I
Please.
download in Excel file, in Excel format, these three ratings, they come in the same column.
Where are you downloading from, please? Is it the compare section?
Yeah.
Okay.
So these first three columns, they appear in the same column if you download in the Excel. Yeah.
Oh, I see. Okay, sure. Yeah, that's a bug. We'll fix it. Guys, let's write this down. You can release a fix over the weekend. Thanks for pointing that out. So we'll fix this.
Welcome.
Hi, Arnab. One question I've typed in the chat box, if you can have a look.
Sure. Can we add a separate category for any fund operating as a factor fund? Currently, the fund categories are completely driven by SEBI classifications. So we can't unfortunately change these. We do have a kind of a small background project going where we're trying to create our own classifications because we've had certain problems with the existing SEBI classification where there's some categories which have too many funds, which should probably have more categories. This would be possible, but first we'll have to kind of complete the work for having a separate engine classification for funds. Yeah, I mean, I think it might take a month or two for us to get there. And once we do get there, and the classification is completely in our hands, then we'll be able to be totally flexible about how we handle it. But right now, as of now, everything's based on SEBI classifications. Yeah, I mean, not more than that. Not more than that. I would say 3. Any other questions? Just please let us know.
But the scheme's rating, you have given the 3 columns. How can you understand basically?
Sorry, please, could you repeat that?
No, sir. The 3 ratings is there now. How can we understand these things basically?
So there are fund scores that are created by NGEN.
Yes.
The NGEN FS is the main fund score. The other 2 are based on very specific parameters for return only or for risk only. But the main score that's used all throughout the application is called the NGEN fund score. And that's based on various different parameters. And it basically provides a score between 0 and 10 for every fund within its category. But you can independently compare one rating, one score to another. But the way it's calculated is by comparing it to others within this category. So, in this case, you can see, for example, we're looking at this particular category, and you can see the ratings of each funds here. And here, we look at AUM, we look at short-term, medium, and long-term performance. And using that, this score is updated at the end of every month. Once a month, this score is updated. And you can kind of see the history of how the fund score has been doing. Any other questions, please let us know.
Do we have the fund managers changes in this scheme details?
Yeah, we can show you.
Thank you.
Okay, if there's nothing else, we can go and close for the day. Thank you.
Thank you for joining in. You
Thank you
can
very much.
anytime view our past recording on our YouTube channel. There's a dedicated webinar playlist that is created for you. So this week's webinar will be uploaded by next week. Thank you and happy weekends.